So good morning. It's a pleasure to be here. Before I go any further, thanks Justin, AJ, the broader team for pulling this off. Those of you that don't know, it does take even more work when we're at a different location. So please tell them thank you. It's a good meeting, but it took more work because we're here. So thank you for that. My slides are already uploaded on agmanager.info. So here's the URL to that. If you go to Ag Manager, there is a tab called Contributors. I'm one of about a dozen AgEcon geeks that contribute to Ag Manager. So if you click on my name, you'll find these slides. I'm not trying to stand in your lap here, Mark, but I'm getting away from the speaker. You'll see these slides. I'm telling you that because I'm not going to show you every one of them for the sake of time, and particularly if this is a problem, we'll probably skip a couple. I'm going to cover very high level what I think the economic situation is, typical profit expectations. I'm going to spend a little extra time on herd expansion, highlight some tools for that decision. I'm going to spend extra time on international trade, given the current environment, and then we'll take whatever questions we have time for. And if you don't want to ask me a question in front of everybody, I am going to be here a good chunk of the day if you want to corner me later. All right, so you already saw this slide. There's lots of different ways to kick this off. You know, this old Dickens comment, it was the best of times, it was the worst of times. Talks I've been given the last 4 or 5 weeks, I'm starting with some version of this slide. Depends who you talk to, if you're comfortable and excited or scared shitless of the current amount of change going on. And that's the point of this slide. Change is constant, adapt you must. And I'll interject that even if you choose not to adapt, I would encourage you to have bigger cash reserves to absorb the volatilities at play. So we're in pretty uncharted magnitudes of uncertainty is the point. I'm pretty good at staying apolitical when I hold the mic when I'm working for a university. I'm going to do my best to do that today. That's not my point of making any political statements. But uncertainty in the markets is definitely elevated, and I want to emphasize that up front. All right. We're going to do old school. Otherwise, it's going to be a problem. So I'm putting it down. I'll just point back to you. All right. So quick summary. We have not started herd expansion. There's no evidence that in aggregate nationally we're holding back heifers. My best guess is it'll be the summer of 2026 before we see any aggregate examples of that. There'll be individual operations, of course, here this summer that think about it. But in terms of national market relevant, starting that process, I think we're still a good year from initiating that. Hence the question mark, hence 2026. The demand side, we've had a pretty good run, domestic, and I'm going to highlight foreign demand the last 2 years in particular. But if you heard my disclaimer, uncertainty is very high on the demand front currently, and I'm going to try to clarify that on both the foreign demand for U.S. beef and the domestic demand. The domestic part that I'm most concerned about is consumers' comfort. It's not the perception of beef. I think we're convinced, the public has said they like taste, they're willing to pay up for it and so forth when they can. But to the extent we're introducing macroeconomic uncertainty, that could be a headwind for domestic demand as well. So I'm going to belabor that. Next slide. These 2 slides are from LMIC, Livestock Marketing and Information Center, not the one here in Manhattan, but one out in Denver, Colorado. For those of you that regularly hear these, that's a group that pulls together a lot of USD information, pulls together half a dozen of the slides a day, and I bring them to you so I can interpret them. Each row is a calendar quarter, and then the yellow is a row for the calendar year. Moving from your left to right is commercial slaughter, so head count. In the middle is dressed weights. And then to the right is the net of that, commercial beef production. 2024, I put a purple box around the last 3 quarters because the part that most analysts didn't see coming was the magnitude of increase in dressed weights. So we knew we had lower hoof count, but we more than offset that with heavier dressed weights in 2024. So the net result of that for the year was a small increase, albeit 0.1, but nonetheless, a small increase in commercial beef production. Okay? We didn't anticipate that. The good news is the market absorbed those sort of unexpected pounds better than we expected because demand was pretty good, okay? And I'm going to show you some slides about that later. As you move down, these become projections, right? 2025, then 2026. The purple arrow tells you the general trend, and it's the common trend we've talked about for some time, is down. Fewer hooves in the system, right? Fewer mama cows, lower calf crop, eventually lower slaughter numbers is the consistency that's there. The forecast for the middle is maybe some additional small gains in dressed weights. So we'll mitigate that a little bit, but not as much as we did in 2024 is what's up there in front of you. So the net result is maybe 2% less beef being produced domestically this year compared to last. and maybe an additional 3% out into 2026. Next slide. This is the same exercise, same setup, but now we're talking prices. So on your left is fed cattle, 5 market average, and then to the right is Southern Plains yearlings and then calves. 2024 numbers are up there for your reference. The arrows, just to confuse you and make sure you're awake, I've put 2 up here. You know, I just forgot to put the third one, right? So I covered up and flat. I just didn't put one that was down on this slide. But the point of that is it depends on which of these quarters, if prices are expected to be up or flat. Across 2025, 2026 is a flat or improving price forecast. When you get out to 2026, you'll see some of those prices are basically flat or a little ahead of 2025 is why I put them both up there, okay? An embedded assumption in these price forecasts is that reduction in supply, which is what the slide before was about, will occur in a, let's call it stable beef demand environment. And that allows prices to go up because of the supply reduction, okay? The biggest uncertainty sitting here today, early March, is not the number of calves in the system, it's beef demand on what the supply story is gonna, allow us to have in terms of higher prices. I'm gonna say this at least 3 times, which probably means 13 the way I do this, is the industry has had cases before where supply has reduced and prices have went down. We can't lose sight of that, okay? I don't wish that on any industry, and I damn sure don't in front of you that could be throwing stuff at me right now, right? But we can't forget that happens, okay? Often, we see when supply goes down, prices go up, and that's because demand is fairly stable, if not improving, and that gives us the higher prices, but we cannot take it for granted. Next slide. All right, so I got half a dozen here just on the cow-calf side for a minute. USDA puts out a January cattle inventory report every year, gives us an estimate of how large the U.S. beef cow herd is. This is the history of that going back to 1995. A couple quick points. It's not a news story that the national beef cow herd is shrinking. The trend over time there is declines, right? What I want to interject, though, is the amount of beef we're getting out of every mama cow is going up. So don't convolute the two. We actually have a shrinking industry with more beef production is the general trend, right? And there's lots of efficiencies and reasons for that. That's the long-term point of this. Fast forward to the most recent 10 years on there, you can back out the current cattle cycle. So the previous low was in 2014 when we had 29 million beef cows. We peaked January of 2019 per USDA's numbers at 31.6 million cows. And then most recently, USDA says we started here at 2025 just below 28 million. So I want to highlight we're a little below the previous low in terms of number of beef cows. A lot of people think this is the setting to start herd expansion, right? Because there's this 10 to 12 year kind of historical cattle cycle, and we're to that point in duration on this one. Mother Nature and the broader economic environment will have a lot to do with whether we do, but just looking at old rules of thumb and so forth, we're definitely to that point. Next slide. That same exercise from USDA also gives us an estimate of the number of heifers being held back. That's what this is. Goes back also back to the middle of the 90s. I want you to note how low the bars to the far right are. So historically low number of heifers being held back. That's because of 2 things. One is we have a smaller number of beef cows to even hold them back out of, right? So simple math is the number that's eligible to start with is lower per that long-term trend, right? And the second part, more recently, we haven't started the process of herd expansion, okay? Next slide. I made this comment, but I'm gonna belabor it for a moment. We have a fact sheet on Ag Manager that's been updated 3 or 4 times. It was last updated in 2022, and this figure is on there, and the link's here for you to pull it up later. The punchline across cattle cycles, and these cattle cycles predate everybody in this audience, they go back way in time, is we have a lower number of cows on average across these cycles, but we accomplish more beef production per cow, and a big part of that is dressed weights. Now, I want to interject, it's not just dressed weights, right? We have more breeding success, weaning success, everything before they even get to the feed yard today than we did 30, 40 years ago. So that also gives you more sellable beef per cow at the end of the day. So there's lots of things in this industry that have enabled that. But I want to interject the point, this fact sheet was done in 2022. The trend I just described holds, and it's gotten even steeper. Because if you think about what's happened in the last 3 years, we have even fewer mama cows in the system. So the average cow inventory this cycle is lower. I told you earlier we surprised the market with heavier dressed weights. So the amount of beef we're selling per cow has went up this cycle, okay? So the dashed line that's up there, it's definitely went up. The low gray bar, which is the number of cows, has went down. The quote-unquote efficiency comments about sellable beef per cow has went up a lot in the last 3 years, is the point. We don't need as many mama cows to hit a beef production target as we did 4 years ago, much less 14 or 24, okay? The reason I'm interjecting that a lot at this point in time is when we talk about herd expansion, I don't think we should anticipate the same amount of build back that we've had in the past, because the market's going to react to those additional beef pounds quicker per cow added, because we're going to get more beef per cow added than in the past. You guys follow me? If you think the market works working backwards from beef demand, the volume of beef and the type of beef, and that sends the signals to cattle producers, which is the way I think about the industry, then we won't hit as high of a cow number when we rebuild before we send the signal to stop expanding, which is a nice way of saying before the calf price takes a hit, right? Okay, next slide. If you want more on that, we have several Excel-based decision tools on Ag Manager to hopefully help you make a decision. So if you're thinking about expanding your herd, holding back a heifer, buying somebody else's, there's various ways to think about that. This particular tool, go ahead to the next slide. Next slide, thank you, is derived to give us a net present value number. And that's just an estimate of the economic value of an asset, in this case, a female added to your herd. I have the base assumptions in this tool listed here you can stare at for a moment. You can change these, and I'm gonna give you a couple example changes in a minute, but I wanna get your head around $1,000 cost to run a cow for a year is the base assumption. USDA projected prices for 10 years is what I've put in for the calf prices. For context here in 2025, the number that's up there is 326, okay? And that's a reasonable number still, but when I did this early December, that's what we had in here. And when you hit run on this calculator, the very bottom is the key output. So if I'm gonna do this, what if I hold back a heifer that I expect to give me 7 calves? So my best guess is I'm gonna get 7 calves and then sell her, is the what if we're doing right here. The net present value that's on the bottom right of this slide is $2,394. The way you, let's just round that to 2,400 for simplicity at the moment, is if I can buy this heifer, and I have this cost structure, these price expectations, so forth, for less than $2,400, then I have a higher expected rate of return than the 8% discount that's plugged in this tool. Let's say I go and I pay more than $2,400, then this says I'm locking in a lower expected rate of return than that 8%, is the way you interpret that, okay? Next slide, please. For context, I'm gonna give you 3 scenario changes. One is this exact same tool a year earlier, because we update it usually around the 1st of December, because that's when we get 10-year forecasts from USDA on calf prices, is why we do it that way. A year ago, that 2,400 number was 1,800. Exact same calculator mechanism, but a year earlier said your kind of indifference point for those scenarios was you could pay 1,800, okay? Now, I'll pause for a moment by way of making sure you stay awake. A year ago, how many of you could have bought a replacement heifer for 1,800 bucks? Did everybody hear the question? Yeah, nobody, right? And then fast forward to now, you're probably not gonna buy many you at least go to the bar and brag about for 2,400. I'm making a point of clarification here. This is not a market projection tool. I'm not telling you what I think the market for heifers is gonna be. I'm telling you what an emotionless tool on this future revenue stream, your cost structure, this discount rate, quote unquote, what you should pay, okay? And it's not my job to tell you you should or shouldn't pay. Don't overreact to that. I'm trying to walk up to the point. Every other time in past herd buildup efforts, the market has paid way more for heifers than these tools will ever say. And I fully expect that in 2026, 2027, if we are expanding the herd, and if the uncertainty I'm gonna talk about for the rest of my talk calms down, we'll be north of $1,000, if not $2,000 more than what the tool I'm kicking out is. It's not for me to say that's wrong, but I'm trying to clarify for you, this is not a market projection, because to do that I have to embed market behavior, producers' willingness to do it beyond what this pure data says, okay? Hope you guys follow that. That gets confused a little bit, and I want to try to clarify that while it's being recorded and people can use that later. Next slide, please. The other part of that is, what about differences across operations? So I said the base default is $1,000 per cow per year. What if you change that? There's massive variation in cost structure in this industry. So to the left here is a figure. It's one of the standard figures that's in this tool when you pull it up, is what if your costs are different? Real simply, if you change your cost per year by $150, this is out-of-pocket cost to run a cow in your operation, you can justify per this approach paying $575 more or less. So if your costs are going down, you can pay more. If your costs are going up, you got to pay less, okay? Next slide, please. What if you're more optimistic about calf prices? All I did here was take the base default that you could download from Ag Manager, and then took the 10 calf price years and multiplied it by 1.1. So I just said, what if you're 10% more bullish on calf prices? Is the only scenario I did. Now you can add over $600 to what you could rationally pay for a heifer. Add those two up as an example. If you're a little lower cost operation than average, and you're a little more bullish than average, I just gave you an example where you can pay $1,200 more than the base for this heifer, okay? So there are examples where you can justify a number bigger than the default, but it's also my job to remind you the other direction holds too, is if your true costs are more than 1,000, then your justification has to be to pay less, right? So I gave you kind of the rosy version if your costs are lower and the prices are going up, but simple math works the other way as well, okay? So keep that in mind. Next slide. All right, so calf prices, we're in the world currently of $3 calves, been that way for several months. The way these slides work, the current year, solid blue, is now 2025. The darker dotted ones, kind of a blacker blue, my grandmother would hate that. She sold Mary Kay, and I'm crappy at colors, but more black dots, right, was 2024. And then the prior 5-year average is up there. Please note, going back to about the middle of October, we had a nice run in the calf market, right? I shouldn't say please note. Those of you in that market know that. But the tone was quite strong as 2024 ended, was the point. And we started 2025, for the most part, with that trend continuing. Now, we had a few weeks of a hiccup if you look at the 2025 lines up there. But most recent up there is 355 calf. Next slide, please. Look forward now. So we're sitting here in March. Several of you in the room that are cow-calf producers might be in a position where you're going to sell a calf this coming fall. Relevant question is, what could I expect to get for that calf? I would encourage you to use beefbasis.com to come up with, again, an emotionless forecast of that. The way this particular tool works is it uses yesterday's feeder cattle, the CME, wherever we closed, across different contracts, and historic basis, so the relationship between futures of the board and cash, to come up with a cash price forecast. The specific one I have in front of you is for Salina, selling in the middle of October, a 6-weight calf, steer specifically. You can see up there the projection is 310, okay? So that's just looking at the board with historic basis for that weight, that steer, that date in Salina to come up with 310, okay? I would consider that a reasonable market-based forecast you could use. You can change the location, the date, the weight, and those kind of things to update that. Dodge City and Pratt are also in this. So if you came from the Southwest, instead of picking Salina, pick that. If you came from the Southeast, I would encourage you to pull up the Joplin market or something else that's closer to your operation because it probably matches your situation better. The Beef Basis tool has a map on it. You could pull up a map that geographically shows you all the markets and find the one closest. I like to use Salina because it's the most central Kansas one in here and it hits the most people, and I don't want to wear you out with 47 of these, but just pull up the location that's closest to you. Next slide. All right, I made the comment about $1,000 cost. Some of you in the room might think that's ridiculously high. What the hell's he doing? That's coming from this slide. USDA estimates cost to run a cow per year. They've done it for several years. That's what's here, going back to 1997. There's a long-term trend for the geeks in the room that we're increasing the cost to run a cow on average by $27 per year over this period of time. What's more important, I'd argue, to recognize is we added over 200, specifically 243, to this number in a 4-year period recently. So a lot of people probably still have an $850 cost per year rule of thumb, whatever in their mind. And this is my plea for push the calculator and know your true cost. And the $1,000 I put into the default tool earlier is consistent with this and other metrics. Most operations are spending more on the herd than they recognize is the point, because economy-wide inflation has increased the inputs on about everything, okay? Next slide. So what about margins? So I said something about calf price, I said something about cost. The net of those two gives us some insights on margins. Like I have 3 slides in a row that look like this. At the bottom, you can't see this. This slide is dated early January. It's the last one that LMIC generated. So I'm going to adapt it with you. And for those of you that sell calves, you'll like the adaptation because it's a positive adjustment. This is a history going back to 1997, projections for returns over cash cost. Most of you can probably remember 2014 being a good year that gets talked about a lot. That year up there was 534. The number that's up there for 2024 is $652, which by historic standards was a good year, okay? Projections for 25 were 711. So a positive return of $711 per cow is what LMIC projected the beginning of January. The adjustment or kind of the on-the-fly tweak to this I'll give you is to the top right. Notice that this fall's board is up roughly $10 since the year started, okay? Depends on the day and which contract I pull, but let's just use $10 for a moment. And if you're selling a 6-weight calf, we can add $60 to this number if nothing else changed, right? So that 711 becomes $770 as an adjustment on the fly if nothing else changed. That looks like a pretty big number. That starts to look like a carrot to expand the herd. Next slide. But here's some context. Everything I gave you there was nominal numbers. So what you pay that particular year, like if you go in the grocery store and you're asked this, that's the price. You go in and buy a John Deere tractor, that's the price. Not adjusted yet for inflation, okay? If you ask a geek like me to take a moment and say, how does that 2014 and 2024 number compare once we account for inflation? We're still not quite as good as we were in 2014. You guys follow me? So everything in the economies went up. We can try this again, hopefully. See if it's economic idiot proof. 708 is what's up there. There was 33% inflation over that 10-year period. The bulk of it during the pandemic period, right? The reason I'm emphasizing this is there's no rule of thumb that we have to repeat 2014 margins to initiate expansion. Please don't take it that literal. But I do think there's some producers that remember that experience and say, hey, on an inflation-adjusted basis, we're not that good yet, and it takes a lot more money to run my operation. So on a return on investment perspective, or percentage of what I've got on the table perspective, we're definitely not where we were, okay? So I think the typical producer's been rational to not expand yet, is the point, okay? Now, the carrots to the right are getting bigger, and at least at the moment, inflation has slowed. I'm gonna end my talk with some concerns on that front, but most recently, inflation has slowed some. So I do think we're probably to the point we're gonna start expanding, but I'm trying to be clear is I think producers have been rational, they haven't yet, because of the amount of money that's involved and the net return still hasn't hit, even the 2024 number, what the most recent high was that a lot of people have in their mind. Next slide, please. All right, last comment on this slide is I gave you an example that if you change the cost per cow, you change what you could pay for a heifer pretty quick. That reminder applies here for sure as well. Please note there's a massive variation in cost structure. The Kansas Farm Management Association has a little over 100 cow-calf operations in its database. There's a $600 per year per cow difference between the top third profitable and the bottom third profitable operations. So there's big error bars around what I'm showing you here. And my example earlier about changing the cost by $150 is well within the realm of reality on cost structure. You could probably change it by $300 real quick to start to get to the 600 that's there, okay? So know your cost and it'll change the story. Next slide, please. All right, so let's keep working, move past cow-calf a little quicker for a moment. Yearling prices, 287, similar trend with calves. Up, took a little hiccup a couple weeks ago. Next slide, please. You can use this same beef basis resource to get insights on the margin, the revenue part of the decision, to add weight to calves. So the stocker or the backgrounding segment, you buy a lightweight, you sell a heavyweight. So you need to have an estimate of the value of gain and then compare it with your cost of gain to get some insights on margins. You can use beef basis to do the market projection part of that and then compare your own cost of gain to make a decision. The example I have in front of you is what if I'm gonna either buy somebody else's or retain my own yearling, weighing 725 pounds a month from now, early April, and I plan the middle of August to sell it when it weighs 200 pounds more. That's the scenario I put in front of you. You can use beef basis to project that purchase price as well as the sales price, which is what I've done on the bottom of this slide. And the net of that is, the projection is that animal is gonna gain $310 per head of value, $155 per hundredweight, you're putting 200 pounds on. The way you use that is, okay, what's it gonna cost me to put those 200 pounds on, and am I comfortable with the risk environment and so forth? Pull the trigger, don't pull the trigger, is the way you use that, okay? So that's a historically pretty wide margin compared to 5-6 years ago, but costs have went up quite a bit to accomplish this too, okay? So my same comment earlier about cow-calf, the cost have went up more than most recognize. I would argue background and starker cost have went up more than most recognize also. So please use these kind of market forecasting tools with your own knowledge on cost to inform those decisions. You can tweak the dates, the weights, so forth, till you're blue in the face. For this segment in particular, I encourage you to do that. So if you're thinking about supplementing, and maybe instead of a 1.5 daily gain, you're gonna supplement and target a 1.6, just as an example, do that. So plug in 1.6, don't change anything else, you're gonna sell a heavier animal at the end, right? It'll change the forecast, figure out if it's worth that investment, is the point. Next slide, please. All right, couple of comments about feed yard sector. This is fed cattle prices. Chart set up the same way as the last two like this I gave you. We're in the realm of $2 feds, so we were north of that for a few weeks here. We ended 2024 with a positive tone, just like we did in the calf market. The pullback has been a little stronger than it was at lighter weight classes. Those of you in the feedlot industry know that. I think that's the demand uncertainty that's hitting the fed cattle market. Next slide, please. Every month I put out this chart, and I'm going to remind us how it works to give Justin credit. I use the Focus on Feedlot survey from the Animal Science and Industry Department to benchmark death loss, weight gain, in weight, out weight, those kinds of things. I marry it up with fed cattle, feeder cattle, and grain prices for Kansas, and I put out what I would call this barometer of profit trends. It's really important to keep in mind, this presumes no hedging, so you're paying the cash rate for incoming animals, paying the cash rate for grain, taking the cash price for animals leaving. So any risk management you're doing, you're gonna mitigate some of the variation in this exercise. And I'm giving nobody any credit for grid premiums, okay? So if you regularly get $25 per head off the grid, you would add 25 bucks to this, is one way to think about that. So it's a barometer of trends. I'm gonna call out the March number, and those of you, I know you can't read this in here today, but you can pull it up later. The third row of numbers for March is $59. The way you interpret that here is when we did this the middle of February, best guess for this example that I'm modeling is a steer leaving a Kansas feed yard in March would have a positive return of $58.61 per head, okay? That's how you interpret these. As you move to the right, you get the inputs, the projected fed cattle price, what I say you paid for the incoming feeder, what the feeding cost. I could take a hit and just pull it so down. Maybe that means I need to speed up. I'm joking, I know I talk fast. So, fed cattle prices, the break-evens for that are up here. The part I want to highlight is as you go down this slide, so projections for cattle leaving the yard later is what you're getting at, you'll see these projections turn negative. The very bottom row is probably the easiest one to read, is steers leaving in October. The number that's up there is a loss of $106 per head. What's underneath that is a projection that fed cattle prices are going down and you paid more for the animal coming in. So if you look up there, there's a decline in the projected fed cattle price and the presumed feeder cattle price, which is one of the middle columns, is higher, okay? If both of those occur, then by definition, that squeezes the margin unless there's a massive improvement in cost of gain to offset it, right? So that's how you use this resource. It's a barometer of general trends. Next slide, please. All right, I said I'm gonna talk about beef demand. I'm gonna talk specifically about trade more because I think there's as much unknown and moving parts on that today as maybe anything, so I'm gonna try to give some context there. Next slide, please. I'm gonna do less of a what demand is talk than I normally do, but there's a lot to clarify about what demand is, and it's not just consumption. Half this room's heard me belabor that, and I'll do it till I'm in my deathbed. But in November, I gave a full talk on that. There's YouTube recordings of that. Please make use of that. I'm gonna save you from it today for the sake of time. Next slide, please. I'm gonna give you this slide to kind of give you that demand concept point and then get in the weeds. This slide right here is a scatter plot by calendar year. Horizontally is pounds of beef per capita, or consumption per person estimate in the US. Vertically is USDA's reported all fresh retail beef price. It's deflated, so it's adjusted for inflation over time, okay? Each number up there is the intersection of quantities and prices on a per person basis. First, let's talk about the ugly stuff. It's the red arrow. This is the reminder and kind of where my current concerns are, is when we went from 2007 towards 2010, look at the red arrow, we basically moved just to the left and more or less flat on this particular chart. The way you interpret that is you move to the left, the amount of beef being consumed per person is going down from roughly 65 pounds towards roughly 60 over that period of time. And because we didn't go up, we failed to increase the retail price. So retail price on an inflation-adjusted basis sort of stayed the same. That's why those are flat. And yet we had a smaller market. So I gave you my comment earlier, just because supply declines doesn't mean price goes up. That's where that word of warning is coming from, is we've experienced it, okay? And there's other points in time in the 80s and 90s that would be lots of examples of that for those of you that have more history than me. But you don't have to be that old to remember the history's been through that. The industry has experienced it, okay? Now the green arrow, the more fun thing to talk about, is more recent years, we've actually had the cases to where we've increased consumption per person and the prices went up. That can only happen if demand is improving. When you put more volume on any market and the price goes up on an inflation-adjusted basis, that only happens if the valuation of that product's going up in the public's eyes. Otherwise, they would pay less because there's more volume on there and they wouldn't have to, right? So think about it, a little bit of a bidding war for those pounds. It's a great thing for the industry. It's a testament to beef demand strength and beef quality more generally, okay? In 2024, to the top right, because that's the add-on to this chart, is we experienced almost a 3% increase in total pounds here and a 5.5% increase in price nominally, but even if you adjust that for inflation, it would be a net gain because we did not have 5.5% inflation in 2024, so the net price would still be positive. Price went up and volume went up. 2024 demand was good. That's great. We can't take it for granted, but it was great. Next slide. Now, this is a ugly chart I put out every month. It's called the Export Demand Index. So what I'm doing here is using USDA trade data and a lot of other stuff, but mainly Foreign Ag Service data, to try to come up with a demand measure of foreign demand for U.S. beef. And I'm going to tell you who those customers are here in a couple slides. But first, just note the simple trend. This one starts in 2010. Yes, there's lots of seasonal variation, and yes, there was a pandemic hiccup and so forth, but the long-term trend is foreign demand for U.S. beef has grown. This index going up is good, is a simple way to think about it. Next slide. This is the same information just starting since 2020. So think pandemic till now. Things got really bad early in the pandemic when it came to foreign demand, right? Macroeconomic uncertainty and port issues in particular were a challenge. And then we had a peak in 2021. So global economic activity was good before we had inflation. Then we had inflation and it hit, so things came down. Fast forward to now, 2023 through 2024, there was a general upward trend in foreign demand for U.S. beef. My slides 2 slides ago told you domestic demand was up in 2024 because we consumed more per person and the price went up, and foreign demand was up. That's great to talk about when both are going up, okay? So that was a really good thing for 2024. For some context to the far right, USMEF, U.S. Meat Export Federation, they estimate each year what the value added per exports to every barrel and gilt as well as steer and heifer in the U.S. is. The number they put out for cattle was $415 per head in 2014. So this is real money, if you want to think of it that way. That's roughly $29, $30 per hundredweight of value that was added to a typical harvest steer in 2024, okay? Next slide, please. Who do we do trade with? You guys can pull these up more later. In the current environment, I'm just trying to clarify things. So in 2024, here's a volume summary. And I'm going to make the distinction between volume and value several times. But to the top left is the import, beef and veal import summary. And to the bottom right is exports. Please notice that you'll see Canada and Mexico are on both, right? So we have pretty significant trade both in and out of this country with our fellow North American countries, okay? We import from the southern hemisphere in addition to those 2 countries. So you'll see Australia, New Zealand, Brazil on the import list. And then we export a lot to Asia. So you'll see China, separated from mainland or not, as well as South Korea and Japan, okay? I don't want to give you 2 hours just on this slide, but I'm trying to give you a flavor of the trading partners in 2024. Next slide, please. What's the net of imports and exports? I want to interpret this slide and the one after very carefully for you. We are a very large beef producing country. We're a very large beef importing country. We're a very large beef exporting country. And I often get the question, Glenn, what the hell? Why are we importing and exporting the same thing, right? That just catches people off guard. And I try to clarify saying we don't import and export the same thing. Beef is too broad of a term to really understand trade, okay? Now, it's a catch-all for these slides, but the way I usually make this point is raise your hand if you had beef tongue and beef liver in the last week, okay? And I'm not anti those products, don't overreact to it, but my household didn't either. And the main reason they didn't is somebody else in the world values those products more than the typical US consumer. And in my eyes, there's nothing wrong with that, right? That's why we export them, right? Now, the flip of that is, let's take this room and let me take a parallel room for anybody, any country else in the world, put them over here, and I ask how many of you had a hamburger last week? There's gonna be a lot more hands on this side of the room go up than from any other country, right? So you guys get the point. Where I'm alluding to is we import a lot to support ground beef production because we're a ground beef and other beef item consuming country, but there's other items that have more value elsewhere. So the term beef is too broad to understand the mechanisms of trade, is the point, okay? Now with that disclaimer and kind of reminder in mind, this slide ignores that distinction. It just puts them all together and says, what's the net of the volumes, okay? This particular slide is in billions of pounds. There's nothing about economic value, it's just volume, okay? If the bars are positive, so if they're going up, that means we were a net importer that year. So we imported more pounds than we exported if those bars are going up. And that was definitely the case most recently. You can see that, okay? There's examples to where we actually import less. So some of those bars are going down. But in most years, we import more tonnage than the tonnage we export, okay? So on tons, that's the case. Next slide, please. This is values. So now we're talking economic dollars, not just tons, okay? Same kind of exercise, but we're talking money rather than just volume. You guys follow the distinction? I put a purple line here just so you can see it's not bars like the last slide. So I put a purple line through it so you can see where 0 is. Most of the years, specifically 13 of the last 18, there's a net positive export value for the industry, which means on economic money perspective, we're exporting a higher value out the door than what we're paying what's coming in. The net of those two is positive. The exports outweigh the imports on a value perspective in 13 of the 18 years on this slide, okay? There's lots of ways you could put summaries around that. If you want a real simple, crude one, if you just add up those 18 years, the net of that is $12.7 billion of net gain. Export value going out was bigger than the import, the expenses for imports coming in over that period of time. Next slide, please. The real geeks in the room can read this particular slide later, but what I just gave you was a very aggregate beef cattle summary. In reality, you break that apart by live animals versus beef versus variety meats versus hides and skins. The punchline of this, and the reason I'm interjecting this, is not the specific numbers, but to remind us, we regularly in this country have a negative trade balance on live animals. We import feeder and fed cattle, put them eventually into our feed yard, harvest them here. Kind of by definition, that's a net negative because we're paying for something to come in on the live animal perspective, right? Live animal generally, so this includes feeders and fed. But we're regularly positive when they go out the packing door, right? After that, okay? So 11 of the 18 years was a net positive on beef and veal. All 18 years was positive on hides and skins, and 16 of the 18 were positive on tallow, grease, and variety meats. And when you sum up those individual differences, you come up with that same 12.7 I gave you on the last slide, okay? So another part of the confusion in this story is we are a net importer on cattle, that's underneath this, but we're a massive net exporter all the time on hides, most of the time on things like tallow and variety meats, and more often than not on beef. So the data can be messy to understand. Hopefully you guys are following me here. But the truth is beef isn't beef, and cattle aren't beef. And this industry is in part better off because of its trade, is the real blunt point. Next slide. So you probably know where I'm going with this, given I'm trying to stay apolitical, but I am concerned. In 2022, Daryl Peel and I were asked to say what would happen if beef imports and exports declined. So I'm going to highlight what we found in 2022 for you. Here's the link to that report. You can pull it up later. It's an 85-page report that'll help you sleep tonight for those of you that need help with that. I'm just going to give you the punchline. Next slide, please. For context, when we did this, the 5-year history of trade for 2016 through 2020, and I'm highlighting this because there's not much pandemic effect in these numbers because we had like 8-9 months of the pandemic that would be embedded in this, is you can see the export pounds value and price, the implied price per pound, and then the same on imports. What I want to really impress on you is the implied price per pound for exports exceeds imports, and that's regularly the case because what we're sending out the door is of higher value on the global market than what we're importing. Mainly because the main thing we import is an input into our ground beef production. It's not a final product, it's an input, right, to blend with our 50% trim here in the US. That's what underlies what folks like me say, this is a net economic gain, because the value going out the door per pound is higher than what we're importing, okay? And that was the case for 2016 through 2020 when we did this study. Next slide, please. So what did we find? If exports and imports go down by 10%, prices of feeder cattle and fed cattle would decline in all 10 years after that. The biggest decline is immediate in first year, 8 to 15%. The quantities of feeder cattle and fed cattle would decline. And then it gets mixed bag on beef. So wholesale and retail beef are split in our analysis because you have end user retail, but wholesale is before we decide whether to export it or not. So you got to talk about both. Prices for consumers go up, quantities for consumers go down. Economic loss abound is the punchline of this, okay? Next slide, please. Put that into dollar terms over 10 years, the same net present value exercise I did with how you value a heifer. We can do that for this what if on trade. Almost a $20 billion loss for the live animal segment. More of that is borne by feeder cattle sellers. So think cow, calf, backgrounder, stocker is in that group in this model. The number that's up there is 12.9 billion loss over 10 years. And then fed cattle sellers are an additional 6.8 billion, okay? So almost $20 billion when we did this in 2022. I did an adjustment for you earlier on a profit chart. Things have changed in the last few months. My adjustment for you on this report right now in March of 25 is I don't know how much to scale up that 20 billion, but it would be a lot higher. So think about how much more valuable beef and cattle are today compared to then. It would be, I'm gonna say 20% for sure. It's more likely 30% higher loss numbers if I hit rerun on this report today. Next slide, and I'm gonna push towards wrapping this up. Meat Demand Monitor, several of you know I run the project at K-State, funded by the beef checkoff and the pork checkoff. It's a deep dive into domestic consumers, issues, what they buy, why they buy it. I'm gonna wrap up with some domestic comments. Shout out to the checkoff, they fund this. Current beef support is slated to end September. We're gonna try to get it renewed. Until it ceases, every month, everything will be on Ag Manager. Next slide. One of the things I've asked every month is household finances. How do your finances compare now versus the past? 20% of the public in February said their finances are better than a year ago. 29% said they're worse. The balance, about half, said they're the same. I want to impress on you the biggest change that people make when they say their finances are deteriorating is they don't go to a restaurant. So the bottom right slide here is a dollar spent on food, at home, away from home. The biggest change is food expenditures away from home go down, okay? And we've seen this for several months. I'm interjecting this because if, in fact, domestic economic activity slows, I think the food service channel in particular is going to take a hit or fail to rebound, however you want to phrase that, compared to the grocery store channel. Next slide. Inflation and stagflation, my last comment. I know we're short on time. I'm going to put a bow on this. We also ask every month in the MDM, what do you think future meat prices are going to be? Specifically ribeye steak and ground beef for the first two categories on this slide. I have the February values on this chart. So February of 25 is the purple bars, and the prior 3 years, the February. So there's seasonal variation in this, is why I'm doing it this way. So I'm taking out the seasonality just to show you February's over time. Please notice the purple bars are greater than both the gray and the green. The public's getting concerned about meat price inflation compared to the same point in time the last 2 years. Okay? Next slide, please. That's consistent with a growing theme of people getting concerned about stagflation. And I put this in red because economists hate talking about this. Are we on the process of slowing economic activity while also inducing inflation? If that happens, and God help us, I hope we avoid it, or if it does, it's short-lived, that's not good. Next slide. Some of that comes from this point. I've been trying to discuss this in the media. Raise your hand if you like the price of eggs. I would argue everybody's well aware egg prices are quite high, but I would also argue that everybody's overreacting to egg price increase. And what I mean by that is I'm not trying to take a step at the egg industry, but as a percentage of our food expenditures, and certainly as a percentage of your household expenditures, eggs directly and indirectly are pretty small. The reason I'm highlighting this is I have a genuine concern if the public is overreacting, if you like, to any one category, and at the moment it's eggs, you have a self-fulfilling fear problem with consumers, and they start getting concerned about prices more broader, okay? I think we're doing that as we speak, and that is not good for beef demand. Next slide. Skip this, you guys got my point earlier. Next slide. Next slide. Let's take whatever questions because we need some time, whatever I have left. To put a bow on it, 2025 started really good for cattle producers on the supply and demand front, but we've really magnified uncertainty, particularly on the demand front, both domestically and abroad.